Open any social media app today, and you will find someone aggressively pitching the exact right moment to buy the next big tech stock. There is an overwhelming cultural pressure to find that one hidden gem before it explodes in value. But there is a massive disconnect between that digital frenzy and the physical reality of the actual stock market. Pouring all your money into a single company introduces company-specific risk. When you buy individual shares, your financial future is tied to a single CEO's decisions, the success of one product line, or the outcome of a single quarterly earnings report. For the average beginner, this creates a toxic behavioral loop. Investing turns into a compulsive habit of checking prices every hour, generating constant anxiety, and ultimately treating the market like a high-stakes casino. Look at this line chart tracking a single concentrated stock over time. Because all the capital is isolated in one place, unpredictable corporate scandals or supply chain failures can wipe out a portfolio almost overnight. This sharp decline usually triggers an immediate psychological reaction. Investors panic and sell their shares at the exact bottom of the drop, locking in a permanent loss in a desperate attempt to stop the bleeding. To capture the immense wealth generated by the American economy without being wiped out by one isolated failure, we need a different structural approach. The structural solution to this risk is the S&P 500. It shifts the focus from the performance of a single company to the collective strength of the American economy. This system monitors approximately 500 of the largest publicly traded U.S. companies, spanning every major industry from technology to healthcare. Because it tracks such a massive cross-section of the market, investors treat it as a definitive report card for big business. This network diagram represents how that scale creates diversification. Diversification means spreading your investment across hundreds of assets so that you are no longer reliant on a single business. If one CEO makes a catastrophic error and their stock fades to zero, the overall structure remains intact. The simultaneous growth of the other 499 thriving companies can easily absorb the blow of that single failure. By investing in the aggregate, structural survival neutralizes individual volatility. The chaos of picking a single winner is replaced by the predictable order of owning the entire ecosystem. It is easy to assume that buying into the S&P 500 means your money is split into 500 perfectly equal slices, but this tree map diagram shows how the index actually functions. The S&P 500 is market cap weighted. This means the companies with the highest overall valuation, giants like Apple, Microsoft, and Amazon, take up the most space and drive the majority of the index's upward movement. Because of this structure, the index has a built-in self-cleansing mechanic. When a company shrinks, loses its competitive edge, or fails entirely, its slice becomes smaller until it is automatically dropped out of the top 500. You don't have to monitor the news or click sell. When old businesses fail, thriving, newly dominant companies are promoted up to replace them. The S&P 500 operates as a ruthless evolutionary algorithm, continuously adapting to ensure you always own the most successful businesses in the United States economy. This evolutionary machine requires one final crucial variable to actually generate wealth: time. You have to change how you look at the charts. Take a look at this one-year chart. Over short windows, market downturns routinely cause terrifying drops. But zooming out to 20 years, that volatility becomes statistical noise, revealing a relentless upward trajectory driven by economic expansion. This long-term trajectory is the foundation for compound growth. By reinvesting dividends, your returns generate their own growth, expanding wealth exponentially over decades. Time in the market dictates your success, rendering the stressful attempt to perfectly time your buys and sells completely unnecessary. This passive, diversified approach is exactly why Warren Buffett advises most people are better served by index funds than picking individual winning stocks. Because many platforms allow you to buy into these funds with low minimums, you can access this strategy with a fraction of a paycheck. Like any financial asset, index funds carry risk, and past performance cannot guarantee future results. But true wealth building is rarely about overnight speculation. It is about consistently owning a piece of the greatest businesses in the world, letting the mathematical power of the aggregate do the heavy lifting, and allowing time to build your fortune.